Ford is really responsible for the entire mass manufacturing industry.
You know, there's a lot of things about Ford that I think are really interesting.
What it takes to succeed in this digital, connected electric product are talents and know-how and a way of managing the business is different than what we've done in 118 years.
Elon Musk has just sent shockwaves through the automotive world with a groundbreaking move that could forever change the way you thought about Ford. For more than 100 years, Ford has been a giant in the industry, renewing innovation and the essence of American ingenuity. So, what has Elon Musk pulled off this time that has the entire world buzzing? Let me tell you all about it. A bold gamble or a desperate move? Elon Musk just executed what feels like the business coup of the century by buying Ford Motor Company. Yup, that's right, Ford, the veteran titan of American cars. No one could have predicted this. For years, Tesla and Ford have been fierce competitors, locked in a relentless battle to dominate the electric vehicle market. Ford's been scrambling to bring some innovation into their electric offerings, while Tesla's been surging forward, leaving everyone else struggling to keep up. But here's the big question on everyone's mind. What's Ford's play here? Why would they let go of such a massive piece of American automotive history? Is this a bold, strategic move to accelerate their transition to electric vehicles? Or is it a desperate attempt to survive in a rapidly changing industry? Why? Ford is currently facing significant challenges, and its reputation in the automotive sphere is taking a hit. There are three key factors at play that have led Ford to make some critical decisions. Let me break it down for you. Drastic sales. Let's look at the sales figures, which are anything but rosy. In 2023, Ford's overall vehicle sales dipped by roughly 2.5% compared to the previous year. A considerable setback. Particularly impacted were their passenger car sales, plummeting by a staggering 20% as Ford shifted its focus more toward SUVs and trucks. This strategic pivot might seem daring, but was it the smart move? The financial implications become even more pronounced when examining losses per vehicle sold. In recent reports, Ford indicated an average loss of over $132,000 for each of the 10,000 electric vehicles sold in a specific quarter, an increase from last year's average loss of about $40,525 per vehicle. This stark contrast underscores the urgent need for Ford to reassess its pricing and production strategies to avoid further financial deterioration. Ford's losing more dough on each electric vehicle than most people make in a year. We're talking a mind-boggling $132,000 per car. That's not a typo, folks. That's the cold, hard truth hitting the blue oval right where it hurts. Now you might be thinking, surely they're not pumping out too many of these money pits, right? Wrong again. Ford managed to push 10,000 of these financial sinkholes out the door in just one quarter. Do the math, and you'll see they're flushing over $1 billion down the toilet. Dangerous finances. Ford's shiny new Model E division just bled out a whopping $700 million in quarter one of 2023. That's not just a loss, it's a financial hemorrhage of epic proportions. We're talking negative margins that'd make even a Vegas casino blush, over 100%. Now, let's take a moment to see what these numbers mean for Ford. First off, it really shows just how challenging the electric vehicle market is proving to be. Expectations were sky high and the stakes couldn't be higher, but reality is showcasing a different story entirely. Everyone knows that entering this highly competitive market isn't just a stroll down an easy street. It's a jungle out there, filled with fierce competitors and obstacles that can derail even the best laid plans. Ford isn't just fighting against rival car manufacturers, they're battling public need, supply chain issues, and the daunting task of converting a legacy brand into an innovation powerhouse. These are the two key factors that forced Ford to make a decision, but the third part is where it all clicks together. And you will understand why Musk is so attracted to Ford, even though it looks like they are failing as a company. Adapting to pressure. Investor pressure is steadily increasing on Ford Motor Company, and the situation is far from appealing. The financial challenges the company is grappling with are serious, exacerbated by a troubling absence of clear guidance regarding their electric vehicle strategy. This uncertainty has caused considerable concern among analysts and investors about Ford's long-term viability. Let's get into the numbers. Ford's financial situation has been in the spotlight recently, and the latest earnings report revealed a significant miss compared to expectations. The company reported adjusted earnings per share of just 47 cents, while analysts had projected around 67 cents. That's not a minor discrepancy, it's a significant gap. The disappointment largely stems from an unexpected spike in warranty repair costs, which soared by an astonishing $800 million in the second quarter alone. This financial misstep has caused Ford's stock price to plummet, down an eye-popping 18% in a single day. All prior gains for the year wiped out in an instant. These financial hurdles have given rise to what analysts are labeling a code red situation. The rising costs associated with warranty claims and persistent quality concerns are stacking up, leaving investors anxious and uncertain. To contextualize the issue, Ford spent approximately $4.8 billion last year on fixing customer vehicles, a sum notably higher than the industry average. Now, let's address the heart of the problem, the glaring lack of a robust electric vehicle strategy. As Ford navigates the shift to electric vehicles, it's becoming increasingly clear that their plan is foggy at best. The company anticipates losses in its electric vehicle division could reach a staggering $5.5 billion this year. That's a considerable weight pulling down overall profitability. If significant changes aren't made, Ford risks lagging behind competitors like Tesla and General Motors, both of which are reporting solid profits and ambitious growth prospects, while Ford grapples with instability. With mounting pressure from frustrated investors, concerns about Ford's future are swirling. Analysts emphasize the need for substantial internal changes to restore investor confidence and ensure long-term sustainability. This brings us to the reason for a sale to a financial heavyweight like Tesla. So now that Ford is weakened, Elon is seeing it as an opportunity, like something to capitalize on. But this makes you question, what kind of opportunity can he see in this dying empire? And how did Ford land in such a precarious situation? Let me explain. Ford's financial challenges are a direct consequence of an aggressive price war in the electric vehicle market. In a battleground marked by intense competition, Ford has been forced to reassess its pricing and production tactics just to remain afloat, yielding dramatic impacts on its financial health. Price war. The ongoing price war in the electric vehicle market is shaking Ford to its core. This isn't merely a minor adjustment, it's a wake-up call compelling Ford to reassess its strategies and navigate a rapidly evolving competitive landscape. At the eye of this storm are heavyweights like Tesla and BYD, whose aggressive pricing tactics are derailing Ford's financial plans and market position. The company has ambitious goals to escalate its electric vehicle production, but a perfect storm of soaring production costs, quality control challenges, and shifting consumer preferences has made progress difficult. Initially, Ford aimed to produce 600,000 electric vehicles by the end of 2023. However, this target has now been postponed to 2024 due to a notable decline in demand for its electric models. This setback highlights a troubling trend across the electric vehicle market, where growth has faltered as consumers, once captivated by cutting-edge technology, become increasingly focused on price. The price war itself is a key factor in this upheaval. Competition intensified dramatically when Tesla cut prices across its entire lineup in early 2023, attempting to retain market dominance amid rising inventory levels and waning demand. This bold move forced Ford to respond by slashing prices on its Mustang Mach-E by as much as $5,900 to remain competitive. While necessary to attract buyers, this price reduction significantly eroded profit margins for Ford's electric vehicle division, Model E. However, Ford isn't the only one feeling the pressure. The market dynamics are shifting quickly. As the price gap between gasoline-powered vehicles and electric vehicles narrows, now nearly $5,000 less in the first half of the year, consumers are rethinking their purchasing decisions. This new price sensitivity has led some dealers to decline shipments of the electric Mustang Mach-E due to lackluster customer interest. The changing landscape underscores that affordability is becoming a key factor for buyers, leaving companies like Ford scrambling to adapt. Moreover, Tesla's aggressive pricing strategies have not only unsettled Ford, they've set a benchmark that other manufacturers must follow. BYD, another strong player in the electric vehicle sector, is also adopting competitive pricing tactics, further tightening the screws on legacy automakers like Ford. As these companies continue to innovate and advance their offerings, Ford faces a precarious challenge. How can it achieve profitability in such a fierce pricing environment? The challenges ahead are significant, and every strategic move will be crucial in this evolving battle in the automotive industry. So what's Ford's strategy in light of these challenges? They are proactively taking steps. The company has announced a substantial $12 billion reduction in spending on battery-powered vehicles and has delayed the launch of new electric vehicle models, all in response to the declining demand. In addition, Ford has recalibrated its strategy to electrification, retreating from its previous ambition to achieve a fully electric lineup in Europe by 2030. This adjustment comes with a sobering realization that consumer appetite for electric vehicles is not surging as they had anticipated. As the price competition continues, Ford has revised its timelines for reaching those ambitious production targets. They are now projecting losses of $4.5 billion on their electric vehicles this year, up from an earlier forecast of $3 billion. This underscores the significant financial strain that aggressive pricing and decreased sales are placing on the company. But the price reduction isn't the only strategy that Ford has tried. They have made multiple attempts to navigate the challenges posed by price wars and intense competition. Failures and lessons. As the competition intensified, Ford's CEO Jim Farley has openly warned that without a clear and unique value proposition for its electric lineup, Ford risks falling into the trap of commoditization. This could swiftly diminish any price advantages the brand has struggled to maintain. Despite ambitious efforts to innovate with standout models like the F-150 Lightning and Mustang Mach-E, these vehicles struggled to carve out a distinct identity when measured against titans like Tesla and BYD. At the heart of Ford's challenges lies a significant shortfall in standout features among its electric vehicles. While the Mustang Mach-E is marketed as a sporty SUV and the F-150 Lightning touts its strength as an electric truck, neither boasts the groundbreaking technology or compelling features needed to attract consumers away from Tesla's Model Y or BYD's leading models. Tesla's supremacy in battery technology, advanced software integration, and state-of-the-art autonomous driving tools presents a formidable barrier for Ford, leaving it lagging in crucial areas. Compounding these issues is Ford's inconsistent branding and messaging strategy. Attempting to appeal to a broad range of consumer segments, from eco-friendly shoppers to devoted truck enthusiasts, has muddled the company's identity. This scattershot approach results in confusion among potential customers, who may be unsure of what Ford represents in the electric vehicle arena, diluting the brand's impact. In contrast, Tesla has established a strong brand persona founded on innovation and sustainability, making emotional connections with consumers far easier. There's also the missed opportunity to leverage Ford's illustrious heritage as a powerful asset in distinguishing its electric vehicles. The Mustang name, laden with historic significance in American automotive culture, could elevate the Mustang Mach-E from being just another electric SUV. Unfortunately, Ford has not fully capitalized on its storied legacy in a manner that resonates emotionally with buyers. Instead, the focus tends to center on technical specs and competitive prices, which may fail to ignite excitement in the same way a nostalgic narrative could. Also critical is Ford's ability, or lack thereof, to adapt in a rapidly evolving electric vehicle market. With consumer preferences shifting and technological advancements accelerating, Ford's slower response to emerging trends puts it in a vulnerable position. For instance, while Tesla regularly updates its vehicles with new software features remotely, Ford has grappled with challenges related to recalls and quality control. These issues not only undermine consumer confidence, but also hinder the company from keeping pace with nimbler competitors. So now I know! You're probably wondering why Musk would want to buy this failing company. Well, let me explain. It turns out the market is not working for Tesla too. Tesla is currently grappling with significant challenges that have led to a notable decline in its financial performance. The downfall of Tesla. In the first quarter of 2024, Tesla faced a dramatic 55% decline in profits, with earnings falling to $1.1 billion compared to the previous year. This significant drop can largely be attributed to a 9% reduction in revenue, raising substantial concerns among investors regarding Tesla's competitive standing in a rapidly growing electric vehicle market. As competition intensifies, the company is encountering mounting pressure to sustain its market share and profitability, both of which have traditionally relied on robust consumer demand. In addition to these financial setbacks, Tesla reported an 8.5% year-over-year decrease in sales. This downturn has led the company to implement significant workforce reductions, laying off approximately 10,000 employees as part of its cost-cutting measures in light of dwindling revenue. Such drastic actions point to deeper challenges within Tesla's operational framework and shifts in market demand. The once unstoppable growth trajectory of the company is now under close examination, raising concerns about its ability to adapt and succeed amid intensified competition from both established automotive giants and emerging players in the electric vehicle sector. Tesla's current predicament marks a pivotal moment for the company as it confronts these challenges while seeking to reassure both investors and consumers regarding its future viability. The combination of shrinking profits and declining sales leads to critical questions about Tesla's strategic direction and its capacity to uphold its reputation as a frontrunner in the electric vehicle industry. Plus, even if they figure that out, Tesla has one big issue they need to face: increasing competition. Chinese manufacturers are rapidly enhancing their competitive edge and becoming a significant challenge for Tesla, posing a serious threat to its market share and financial performance. This trend is not a fleeting phenomenon. It's a substantial wave reshaping the landscape of the electric vehicle sector. Tesla's dominance is increasingly at risk, especially in the US market, where it might soon relinquish its title as the leading seller of electric vehicles. Recent reports indicate a notable decline in Tesla's sales, contrasting sharply with the significant growth experienced by its competitors. This shift in dynamics could pave the way for a change in market leadership, challenging Tesla's long-standing supremacy in the electric vehicle sector. As rival manufacturers ramp up their efforts and introduce innovative models, the competitive landscape is evolving rapidly, placing pressure on Tesla to adapt in order to maintain its position. To begin with, the shift in market share is striking. BYD, a frontrunner among China's electric vehicle makers, recently made headlines by surpassing Tesla in sales for the first time in late 2023. An astonishing 526,000 fully electric vehicles were sold by BYD, compared to Tesla's 484,000 during the same period. This shift marks a pivotal moment in the global electric vehicle arena, where Tesla has long held the mantle of leadership. Moreover, the expansion of Chinese electric vehicle manufacturers is noteworthy. By 2022, China secured its position as the world's largest auto exporter, shipping over 5 million vehicles abroad, a significant portion of which consists of new energy vehicles produced by domestic brands. This rapid growth intensifies the competitive pressure on Tesla, as an increasing number of consumers are attracted to these innovative and cost-effective alternatives. Additionally, the Chinese government is aggressively supporting these manufacturers through substantial subsidies, benefiting both producers and consumers alike. This backing translates into markedly lower prices for Chinese electric vehicles, enhancing their appeal compared to Tesla's comparatively higher-priced models. With abundant tax breaks and incentives, it's evident why Tesla may perceive an increasing squeeze on its market position. Innovation is also a key area where Chinese manufacturers excel. They are not merely resting on their laurels. Instead, they are swiftly introducing new models designed to resonate with diverse consumer preferences. For example, NIO and Zeekr are launching feature-rich, affordable vehicles that are capturing the interest of buyers previously loyal to Tesla. Zeekr's sales figures from June 2024 demonstrate this trend vividly, with over 20,000 units delivered, a remarkable 89% increase from the previous year. Clearly, there's a growing demand for these exciting Chinese electric vehicle options. Stock performance further underscores the challenges Tesla faces in this evolving landscape. Over the past 3 years, Tesla's stock has seen a dramatic decline of 65%, with a staggering 40% drop since the beginning of 2024. This downturn signals investor apprehensions regarding the company's ability to sustain its growth trajectory amid escalating competition and internal hurdles. So with all of this happening, Elon Musk appears to be leveraging Ford as a strategic backup plan amid the challenges facing Tesla. By aligning with Ford, Musk can stabilize his own dire situation. Tesla's electric empire. Elon Musk's acquiring Ford Motor Company could significantly boost Tesla's market presence in the highly competitive automotive sector. In the electric vehicle landscape, this merger has the potential to be a pivotal turning point for Tesla. While Ford might be facing some challenges, the strategic benefits of this union are hard to overlook. First and foremost, accessing an established customer base is a major advantage. Ford has been a cornerstone of the automotive industry for decades, cultivating a loyal customer base across multiple generations. By bringing Ford under its umbrella, Tesla wouldn't merely expand its audience, it would gain access to a wealth of customers who already trust and recognize the Ford brand. This transition could be particularly beneficial in regions where Ford has a stronghold, such as North America and parts of Europe. The idea of traditional vehicle owners switching to electric models becomes more feasible thanks to Ford's established relationships in these markets. It's a win-win scenario that could rapidly enhance Tesla's market penetration and acceptance. Let's not forget about Ford's extensive manufacturing capabilities. With a vast network of factories and supply chain assets, Ford's infrastructure could be a game changer for Tesla. Instead of going through the lengthy process of setting up new production facilities, Tesla could utilize Ford's existing operations to quickly increase its electric vehicle output. This would lead to greater production capacity, lower manufacturing costs, and improved profitability, essentially a shortcut to scaling Tesla into a robust player in the electric vehicle market. The acquisition would also allow for a significant expansion of Tesla's product lineup. Imagine integrating Ford's iconic models, such as the F-150 pickup and various SUVs, into Tesla's offerings. This diversification would be crucial for appealing to a broader audience, especially those who appreciate classic vehicle designs but are keen to embrace electric options. By incorporating Ford's popular vehicles, Tesla could connect with diverse market segments, thereby boosting overall sales and enhancing brand visibility. Additionally, the merger offers exciting opportunities for collaboration in technology and innovation. Ford has made considerable advancements in its own electric vehicle initiative, particularly with battery technology and autonomous features. Pooling resources could lead to groundbreaking innovations, resulting in superior products that stand out in a crowded marketplace. Envision the powerful synergy between Ford's manufacturing expertise and Tesla's software prowess, leading to vehicles that not only perform exceptionally, but also redefine industry standards. This acquisition could also create a formidable competitive edge against rivals. The automotive industry is a fierce battleground, with both traditional automakers and new entrants investing heavily in their EV strategies. By acquiring Ford, Musk wouldn't just eliminate a significant competitor, he would consolidate resources, positioning Tesla as a formidable force against industry giants like General Motors and Volkswagen. This strategic move would make it increasingly difficult for rivals to keep up with Tesla's pace of innovation. On a global scale, Ford's established international presence could provide Tesla with an essential pathway for growth. With a robust footprint in various countries, especially in Europe and Asia, Ford's infrastructure would facilitate Tesla's navigation of complex regulatory landscapes while adapting its offerings to meet local demands. The potential for swift global expansion would be significant, breaking down barriers and allowing Tesla to firmly establish itself in new markets. Lastly, acquiring an iconic brand like Ford could dramatically enhance Tesla's brand perception. No longer would it be seen solely as an electric vehicle manufacturer. It would be perceived as a steward of American automotive heritage. This connection to a legacy brand could resonate with consumers who value tradition while also appealing to those passionate about sustainability and innovation. What should we expect? In the rapidly evolving automotive landscape, there's an exciting collaboration on the horizon that aims to redefine the electric vehicle experience. Tesla has built an impressive network of over 120,000 supercharger stations across the US and Canada, a substantial achievement that enhances the driving experience for electric vehicle owners. Starting in 2024, Ford drivers will gain full access to Tesla's supercharger stations, requiring only a simple adapter for connectivity. This development isn't merely a convenience, it represents a significant confidence boost for Ford's electric models, such as the Mustang Mach-E. The streamlined access to fast and convenient charging fundamentally transforms the competitive landscape, making it far easier for Ford to assert its presence in the electric vehicle market. Consequently, the long wait times traditionally experienced at charging stations may soon become a relic of the past. Turning our attention to manufacturing, Ford's extensive factory network symbolizes a formidable advantage. When combined with Tesla's innovative approach, this relationship acts like a turbocharged engine propelling the auto industry forward. By leveraging Ford's established manufacturing expertise, Tesla can significantly ramp up production capacity, akin to activating a nitrous boost. This capacity is vital in a market that's increasingly hungry for electric vehicles. With Ford's robust production facilities at its disposal, Tesla can manufacture more vehicles, accelerate distribution to eager customers, and perpetuate the excitement surrounding its brand, all while optimizing costs. Such synergies define a mutually beneficial scenario. Additionally, the partnership presents valuable opportunities within China, an electric vehicle market witnessing explosive growth due to its vast population of over 1.4 billion and rapidly advancing infrastructure. By collaborating with Ford, which already possesses a solid foothold in China, Tesla can navigate this dynamic market landscape with greater ease. This partnership is analogous to having a knowledgeable local guide when traversing unfamiliar terrain. It simplifies relationship building and enhances the pursuit of lucrative opportunities. Imagine the benefits of such a merger. Immediate access to Tesla's advanced technologies and established supply chains could transform Ford's electric vehicle capabilities. Additionally, aligning with a larger entity like Tesla could alleviate some financial stress, allowing Ford to refocus on what truly matters, innovation and quality improvements, without being hindered by mounting losses. Overall, this partnership is centered on improving access to charging infrastructure, amplifying manufacturing efficiencies, and directly addressing the burgeoning Chinese electric vehicle market. It is as if both companies are setting the stage for a full-fledged renaissance in the electric vehicle sector. Their interdependence is evident as both parties stand to benefit immensely from this collaboration. But what are your thoughts on this electrifying duo? Could this collaboration be the secret sauce for dominating the electric vehicle landscape and turning heads along the way? Let me know in the comments. Thanks for watching, and see you in the next video. See you in